Now I'm discussing about how do mortgage points work. To explain how mortgage point works, let's use an example to illustrate. Say that you want to refinance your home for $2 lakh with a 30-year fixed rate mortgage at 4.125% interest. If a lower monthly interest rate sounds more manageable in the long run and you have the upfront cash to spare, you could purchase points of $2,000 each. So you decide to go ahead and put up $4,000 extra in exchange for 2 points, each worth 0.25% of the interest rate. This effectively lowers your 4.125% monthly interest to 3.625% for the length of your loan. Purchasing mortgage point is something sometimes called buying down the lender because it reduces the amount of interest you will pay over time, provided your intend to pay off the full mortgage. Purchasing mortgage point is sometimes mortgage points sometimes called buying down the lender, called buying down the lenders because it reduces the amount of interest. Because it reduces the amount of interest you will pay. Whether or not buying mortgage point is worth if you will come down to what's known as the break-even point. This is the point at which you have saved more money on a lower interest rate than you paid upfront to purchase the points. The break-even point is different for everyone and depends on things like the size of your loan, its term, and your interest rate. Finding the break-even point involves a bit of math but is relatively simple. There are various tools available to make finding your break-even point easier. You can use a free online mortgage points break-even calculator to find out how long it might take for your points to pay off. Now, what are the concept of mortgage points? Whether or not mortgage points are a good option for you largely comes down to your financial situation, including the amount of liquid money you have available to put towards paying for points. If you plan to stay in the home you are mortgage long term, at least past the break even point, mortgage point can be a great way to lower your interest rate in the long run. On the opposite side of the coin, if you don't plan to stay in your home until you reach the break even point, then purchasing them may not be your best play. It's also vital to consider how much each point is worth. While 0.25% interest decreases might be worth paying for, if the decrease is on the lower end, say only 0.125%, then you might ought to keep your money in the bank. Last but not least, some people argue that investing extra money upfront in your home could decrease the money value because you could invest it in the stock market instead and hopefully earn greater returns. This comes down to your personal investing preference. However, as many homeowners would rather invest in a home that could eventually triple in a value than take their chances on the market. Whether or not investing in mortgage point is right for you will be depend on a variety of factors. Some of these included are whether or not they are an investment you can afford to make. The other thing is that the amount each point brings down your monthly interest rate, And last, whether you plan to plan to stay in the home and until at least your break even point.